This video is going to look at 18 stocks that subscribers to this channel asked to see. 6 of them pay no dividend at all, but there's some famous names like Amazon, Disney, and Tesla, and of course Berkshire Hathaway. The other 11 pay dividends starting at 0.06 to 1% in Nvidia, over 14% in Arbor Realty and Medical Properties Trust. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And this will be my second installment of what I'm going to call these subscriber request videos. And I want to talk about what I'm doing here. These are, I get requests from subscribers all the time to cover stocks. And of course, it just sometimes there's just not enough time to do it. But one of the real advantages about FastGraphs is you can just draw a fast graph and instantly know more about a stock than a lot of people who would spend hours trying to research it could ever learn. That's one of the real benefits. So what I'm doing with these series of videos is I'm going to look at stocks that you asked to see. Some of them I know, some of them I don't, some of them I know a lot about, some of them I know nothing about. Okay, so what I'm going to do here is just simply give you what I see on FastGraphs when I instantly look at these companies, and then I'll let you go further with your own research and due diligence and decide if you want to look any further or not after what you hear in these videos. So let's go ahead and get into the video, and I'm going to start with alphabetical order here. Let's start with the first company on the list in alphabetical order, which is Arbor Realty Trust, Inc. Now, this is a mortgage REIT, and, I don't know a whole lot about mortgage REITs. I've never really invested in mortgage REITs, but I understand the allure. The company's, this particular one yields over 14%. It has virtually no operating growth over the long term here, but let's shorten this time frame down and get rid of some of this cyclicality here and look at it just from the last several years. I'm even going to shorten it again here. And what you see is actually a negative earnings growth. Now, you normally look at REITs with FFO. I don't know if that's appropriate, to be honest with you, for mortgage REITs or not, but we get no forecast data here, but we're seeing a lot of cyclicality and very, very high payout ratios. So I think all of these things are things that you should take into consideration. I'm going to stick with the operating earnings here because we do have forecasts. And one of the things that, kind of bothers me about this, if I go to the forecasting calculators, analysts are expecting earnings to drop. Now, that makes sense in a rising interest rate environment because one of the things we can also do is go to the external links, go into the company's website, and look at, some of the loan programs that the company does. They loan to small and multifamily loans with interest rates rising. There's some issues with housing. I think you should take those things into consideration. The performance record of this company is kind of interesting. Here we're looking at the last 11 years, and I do want you to notice that it has outperformed the market, but it's underperformed it on capital appreciation. In other words, growth has been lower than the market, but the dividend has been many, many times what the SPY ETF has produced. So we end up with almost a 14% annualized rate of return, most of it coming from dividends. And one of the things about a mortgage REIT like this, you run different time frames and you get different performance reports. And, if you look at it from the last 4 years, or actually last 2 years, from 2002 to 23, it has dramatically underperformed the market on a capital appreciation basis, which puts it at a disadvantage to the market, but it's, again, still outperformed it on dividends. So all I'm suggesting here is that you want to be cautious with this company and you want to basically look into it more if you're interested in investing in it. But anyway, that's all I know. That's all I see here with Arbor Realty Trust based on what FastGraph shows me. Amazon is a company that's kind of very interesting. I think the best way to look at Amazon is through operating cash flows. And the best way to look at Amazon is to shorten the time frame right now. And people always talk about FastGraphs makes the graph look good, depending on what time. No, what you're doing is you're measuring the different growth rates over these different time frames, and you've got different fundamental results over different time frames. And obviously, that's going to give you different valuation references. And so it's critically important to look at the different time frames, and it's one of the great advantages of the tool that you can look at it. Now, this is still a very fast grower, even looking at this 9-year historical time time frame from a standpoint of operating cash flow. We did have a period here in 2021 and then a kind of a flat period, maybe 2% growth in 2022, but analysts do expect the company's cash flows to increase dramatically. Now, the company pays no dividend, and it's strictly a function of cash flows. Now, if I look at performance over this time frame and compare that to the market, and remember, there's no dividends here on Amazon. Amazon still outperformed the market even over this time frame, which is relatively short. If I max this out, Amazon has outperformed the market by orders of magnitude. It would have turned $10,000 from January 1st, 2003 into over $985,000 versus the market only increasing your $10,000 investment fivefold, including dividends. So Amazon has clearly been a growth stock, and I'm measuring it here. I'm using cash flow as my measurement. And, going forward, using the forecasting calculator, analysts still expect cash flow to grow at 27.81%. That's pretty powerful. Long-term growth, they expect it to average about 22%. In either case, Amazon, if you're a growth stock investor, looks very, very attractive at today's levels. This is one of the few times you could have actually bought this below since 2015, its normal PE of 25. Current blended priced operating cash flow, I said PE, but priced operating cash flow is 19. Historically, it trades at 25 and then often higher. The orange line is a blended PE of 29.04. So somewhere between these two numbers, 25 and 29, would be fair value for Amazon. So that would indicate that there's some real nice return potential in Amazon going forward, and now might be a really excellent time to buy it if you're a growth stock investor and aren't concerned about dividends. All right, so that's what they show me. Now, Berkshire Hathaway is a very interesting company, and I want to start out by looking at it from a standpoint of operating earnings, and I do want to max this out. One thing I will say about Berkshire, it's had good 11% growth. If I look at performance, this is as max as I can go. This is going back to January 3rd, 2003 to April 5th, 2023. Berkshire has barely outproduced the market by about 1%. Now, it doesn't pay a dividend, but it has outperformed it. But watch what happens when I run different times frame. Over the last 15 years, it's been almost in a dead heat with the market. And this includes forecasting. Over 10 years, it's just basically generally outperformed the market by just a little bit, about a full percentage point and a quarter or so. The last 7 years, it's underperformed the market. So performance changes when you look at a stock over different time frames. But I want to go to the historical graph here and talk about what you see with Berkshire Hathaway. The one thing I can see is that historically the company's grown by about 11% a year going back. Now, the last 15 years, since coming out of the Great Recession, basically, let's draw 16 years to see. Yeah, it's averaged about 11%. So it's pretty consistent in its growth. I call this premium valuation, the blue line. This is the normal line the market calls. I'll call that a Warren Buffett premium. In other words, I think if you're looking at this stock, even though a 15 PE would theoretically be fair value for an 11% grower, especially one that doesn't pay a dividend, you've got the Warren Buffett premium here, which, everybody obviously is smitten with Warren Buffett, and rightfully so. He's been a great investor over a long period of time. Right now, the stock is trading at a very slight discount to the normal PE that the company has achieved over this time frame. And that's what would be important. So if I'm looking at it over the last 5 years, if I go to forecasting calculators and look at the normal multiple of adjusted earnings at around 23, Berkshire Hathaway would be a reasonable expected, double-digit return, maybe 14, 15, 13, 14, 15%, assuming that it continues to perform like it did historically. And again, it gets a quality premium. So there's Berkshire Hathaway for you. I don't invest in a company like this with valuations this high, but I certainly respect Warren Buffett and what he's done. And it's real important if you go into, the corporate website to understand that Berkshire Hathaway is really a holding company, in my opinion, that, owns a whole bunch of businesses because Warren Buffett invests in the business. The next stock on the list is Boyd Gaming. What I want to show you here for Fast Graph subscribers is take the normal PE off here because it really screws up the deal. This has been a very inconsistent company. It had an enormous amount of growth apparently coming out of COVID. It had no growth during COVID. But if I look at this thing from a forecasting point of view, analysts are expecting extremely low growth. I don't really know if this is an investable company or not. It certainly isn't, for my opinion. It doesn't pay, really any dividend to speak of. Analysts are forecasting maybe a dividend, coming up. I don't know if that's true or not. Maybe they've started paying one. But I don't know much about Boyd Gaming, but I just don't consider this an investable company, so I would ignore it. But I do want you to see, looking at it from a fast cap point of view, even if I look at sales for Boyd Gaming, sales have been rather anemic growth at about 4% a year. If I go max, it's been under that, about 3% a year. And you can see this stock has been very volatile at times. And if you can buy it when it's real cheap, you can obviously make a lot of money. But that isn't the case right now on a price to sales basis, nor is that really a case on an operating basis. It may look cheap here, but if I shorten this time frame, again, that's a critically thing to do with and get rid of that anomalous year there. The growth is about 5%, and it's trading at a blended PE of 10. But what's this company worth? I really don't know. Now, let's move on. Let's try to go quickly. I'm going to try to not spend a lot of time on the ones I don't know much about. Camden Property Trust is a residential REIT. So the first thing we want to do here is we want to go to operating cash flow. And I find this one very, very interesting in that it's kind of got an inconsistent growth rate. During the housing bubble, you can see the stock, got extremely overvalued. It did pay a very large special dividend in 2016. You can see that by the spike here. Otherwise, its dividend record has been reasonably consistent over time. It did get overvalued, and this is clearly a lesson in valuation. It has now come into fair value. It offers about just under a 4% dividend yield. You can buy it at around 15 times FFO with about a 6.4% cash flow. So I would call this fully valued, but certainly not overvalued. And going forward, if you're looking for a 4% yield, in something that's, in residential real estate, it might be worth looking at. Again, you can go into the website here right from Fast Graphs, and you can look at some of their different properties and some of their different areas and, what kind of properties they own and how they do it, and do your own homework and due diligence. I would normally not invest in a REIT like this, but if I was going to invest in it, probably now would be a time that I would start taking a look at it based on what I see. Disney has been a real interesting story over the last 5 or 6 years. Prior to COVID, Disney, and let's go ahead and use this feature of Fast Graphs. Let's scroll back. Really, I'm going to scroll back to fiscal year 2018. Now, Disney, I want you to notice, and Fast Graph shows you that instantly, has a September fiscal year. This company was a really powerful grower, 17% growth. It had a nice dividend record, didn't offer a lot of yield during this time, but it did grow the dividend very nicely for many, many years. If I look at performance over this time frame, it outperformed the market by orders of magnitude and even paid more dividend income than the market and did more than double the capital appreciation of the market. So, there was a time when Disney was a very excellent growth stock. But what's happened since COVID came along, everything changed, at least temporarily. The stock was also significantly overvalued. Obviously, they had to close their theme parks. They were able to do some of their streaming business and stuff, so they still were able to make money. They did cut the dividend first, and then they eliminated it totally. And there is expectations of reinstating a dividend in 2024 or 2025. That's still to be determined. If I look at the company from a forecasting point of view, analysts are expecting it to grow at about 23% again, or to resurge its growth. That would mean that it might look attractive here. Long-term growth is expected to be about 23%. So if you were looking to speculate in a turnaround resurgent here, Disney may look attractive at these levels. Again, when you change the time frame, you get a different perspective. The company has fallen into what would be a reasonable valuation for a company that could grow at 25% a year going forward. And that's certainly very possible if Disney can get their mojo back. But right now, they're not paying a dividend. They cut their dividend or eliminated it totally. The stock was was very, very overvalued in 2021 until everything collapsed. And another thing, I think it's important to look at cash flows here. and see that cash flows fell precipitously but are expected to go on. And even looking at it from a sales point of view, we did see a dip in sales, but Disney right now looks attractive on a price to sales basis. So, looking at it fundamentally, this would be a turnaround situation. It's more of a total return situation, not really an income situation at this point, but it might reinstate itself. The next stock I want to look at is Hasbro, and Hasbro is very, very interesting to look at because right now the stock is inexpensive. It offers a tantalizing 5.39% dividend yield. The PE is 11.66. That gives it an earnings yield of 8.58, which looks very attractive. It is expected for it to have double-digit growth for the next couple of years. So if I go to forecasting, the analysts expect no growth in 2023 or low growth in 23, followed by 13% and then 12%. Long-term growth is kind of troubling. They expect a negative 3% growth. When I look at these kind of numbers, I like to check other earnings forecasts. And one way that we have it set up on Fast Graphs is to go to Yahoo. And I want you to show that Yahoo only expects less than a quarter, just slightly over 0.25% growth for the next 5 years. And that they do expect next year to have 13% growth. So, that's consistent with what we see on Fast Graphs. It's a different set of analysts. But the point is, we don't see a lot of growth going forward past maybe 2025. So I don't know if this is a long-term hold or not. The company's growth rate has been earnings growth has been inconsistent. They did come through COVID pretty well, better than most. The stock was overvalued. It did become undervalued. It reacted strongly. It's now fallen again with weak earnings in 2022. Earnings fell 15%, expected to be, again, as I mentioned earlier, flat for 2023, just slightly up, and then double-digit growth for the next 2 years. So this could be a holding that could be very interesting for the next couple of years, but I'd be very careful with this when I do a lot of due diligence and worry about what the long-term prospects are. Hubspot is a pure growth stock trading at very, very high valuations. Back in 2021, it cratered. It's now recovered pretty strongly. Earnings still don't justify it. If I look at cash flows are pretty decent. The only thing that gives this stock any interest at all would be sales growth. It has been trading at price to sales of 10.36. That's been the normal price to sales. By the way, I do want you to understand for normal companies, that's a very, very high multiple of sales, but the company has grown sales at over 30%. If I just shorten the time frame a little bit, it's been averaging about 25%. The forecasting of sales is expected to be about 20% going forward. And let's just see if they even give any long-term growth. Yeah, they give 25% long-term growth. So if you're willing to speculate into a pure growth stock that pays no dividend, that has fallen dramatically and is still reasonably pricey, HubSpot may foot the bill, but this is not one of the type of companies that I personally invest in. Keurig Dr. Pepper, I'm going to look at it from a standpoint of sales here. What's interesting about this stock, when they had the spinoff, they had that $103, in a demerger they called it, had a $103 dividend. But I think what you really got to be thinking about Dr. Pepper Keurig is what it looks like going forward. And, because of that big dividend, I've kind of got some issues with producing a really good operating earnings graph here. And in fact, I don't think I have one because what they had was they had a spinoff, which amounted to a 25-4 spinoff. So, it's a little bit hard to follow now. But if I look at some of the other metrics here, like if I look at basic earnings, let me see if I can shorten this a little more. Yeah, if I look at basic earning growth, I think the stock is probably expensive here. It's expected to grow. It's trading at a blended PE of 29. Long-term growth is only supposed to be about 6 or 7%. So this is a hard one to do with Fast Graphs because of the big spinoff and the special dividend they paid. But I personally think this stock is probably overvalued here from what I can see. But again, more due diligence would be required on it. When I look at Lincoln National, this is a very interesting looking stock here. I'm looking at basic earnings here, which is GAAP. And you can see a lot of, accounting convention. If I look at adjusted operating earnings, we still had this big collapse in 2022. You'd want to check that. One of the things that's interesting is when I look at the normal PE ratio, it's important to know that since coming out of the recession of 08 and 09, this stock has traded at under a 10 multiple or around a 10 multiple most of the time. So that's something that I think you'd want to take into consideration when you're looking at this stock and evaluating this. It's looking at, it is expected to recover very nicely in the next couple of years and maybe perhaps start growing again. But again, I think there's some issues here that I'd want to learn more about. So Lincoln National Corp, which is a life and health insurer, and there's a lot of issues with the rise in cancer and myocarditis and things going on in health, especially the life insurance industry, that I'd be cautious about if I were you, but that's something to look at. Lam Research is a strong growth stock in some ways, but also a very cyclical growth stock in other ways. And once again, when you look at different time frames, you begin to get different perspectives of what this company's growth is. The one thing I want you to notice, the market applies about a 15 multiple to this stock, and that's been, historically attractive. So if you're looking at a 15 multiple and they are expecting a negative year coming up, it might not be a great time to be buying the stock. If I look at it from a forecasting point of view, analysts are expecting a drop in earnings, so you'd want to take that into consideration. But it's, if you're looking for a long-term hold here, it might be attractive, assuming, the company has good growth prospects going forward. When I look at the forecasting calculators, long-term growth is not expected to be too much from the analysts reporting to FactSet. Yahoo estimates are worth checking here. They're only saying 2.28%. So I think this is one that I might pass on as well. I don't think it's, necessarily a stock. It just looks a little too speculative to me. Moving on, try to keep this video as short as I can. Looking at Medtronic, this has been one I've always used as a valuation lesson if you were a teacher. You can see high valuations and dead stock prices coming into the recession, even though the stock did double-digit returns. Then the Great Recession, I call it, the recession of 08 and 09, brought the stock down into some very attractive multiples, 10, 11 multiples. Then the kind of stock recovered back to the 15 multiple, and then back to its normal 19 or 20 multiple. And the stock has now fallen. It is expected to have a couple of weak years coming up. I think that's something you should take into consideration. But you can buy the stock at a much better price than historical. But because there isn't any growth expectations, it's something I think you'd want to be careful of. Long-term growth is expected to average about 5%. The stock does pay almost a 4% dividend. It is A-rated. It has low debt. So if you were ever going to buy it, you'd be wanting to buy it when you could get it at these attractive. Whether it'll come this cheap again or not is to be determined, but it's worth researching at this point now. I think it's trading at a cheap enough price to be worth researching. MPW is one I've done a couple of videos on. I just wanted to update this a little bit because I've been asked. If you look at this stock in a shorter time frame, you can see it better. We're starting to get a little smidgen up. The company has sued the biggest short seller here. There's a lot of information going on. Fundamentally, it still looks attractive. My view of the stock hasn't really changed. I do see some weakness expected in 2023, which would give me a lower valuation expectation, obviously. But, that's growth is expected to be relatively meager for the next couple of years. But you're getting a, 14.3% dividend yield, a blended price to FFO of 4.6. So I still consider this a very attractive income speculation. It'll be determined or not whether management is going to be, changing the dividend, but the dividend still looks like it's well covered by cash flows, FFO, precisely. And even if I look at adjusted FFO, I still see, dividend cash flow coverage, and the stock is certainly trading at a very expensive valuation. It isn't expected to grow a lot, but I don't think this company is going out of business at this stage. Fundamentals still look good. You decide. Nvidia is obviously clearly a growth stock. And if I look at it from the standpoint of operating earnings, the stock followed operating earnings growth most of the years. Let me try to get this into a little better graph. Even shorter, if I go the last 10 years, which includes 3 years of forecast, it's been growing at about 39% a year. It's currently trading at a blended PE of 76. I think it's gotten extremely expensive again. Forecasting, looking at it, expected to grow at 30% a year. I'll give you that. Long-term growth is expected to be at 26%. But what price are you willing to pay for that growth? I currently think the stock has become significantly overvalued again. There was a minute that you could have bought this stock, but I think that minute has passed. I would be speculative about buying the stock now. Onemain Holdings is a consumer finance company. It does have an 11% dividend yield. It doesn't look too bad. I don't know a whole lot about it. Again, this is one you'd want to spend some time in the website learning what the company does. It does personal and auto loans. Apparently, it's been paying a dividend. It paid I guess, a special dividend in 2021, or certainly it raised a dividend, then it cut it. It is expected to, grow at about 6% a year going forward. Long-term growth is expected to be about 10%, but that's coming off of a down year, which I think is what has got the stock price trading low. I do want to point out the stock normally only trades at about a 5.8 times earnings. So if I'm looking at this stock, I would use the normal multiple as my evaluator. And, what you've got here primarily is dividend yield. And looking at it from a standpoint of performance, historical performance going back to 2017, it's outperformed the market because of dividends. If I run it max, since it's been in business, it's underperformed the market on a total return basis, but it's outperformed it dramatically in dividends. And again, you can, so easily shorten time frames and see that it's still, underperformed. It's underperformed dramatically after 10 years. After 9 years, since 2017, it has outperformed, and then it's outperformed again. So, use the tool. It's the Fundamentals Analyzer software tool. Use it to help you make the decisions whether or not you want to be an investor in a stock like this or not. I'll let you decide. Tesla, you got to get rid of the normal PE because it's so ridiculous. The only way you can ever look at Tesla and have it make any sense, look at operating cash flows. It looks overpriced. You look at sales. Sales is where you start to get maybe a potential where Tesla is trading at a price to sales of around 7, which is inexpensive. Its normal price to sales has been about 8. What's going to happen in Tesla going forward? Sales are expected to continue to grow at 25% a year. This is more than just an automobile manufacturer, although that's what it's called. But, Tesla is probably in a reasonable price based on sales now. But from a standpoint of earnings or cash flows, I still think the company is overpriced right now. I've never really been able to find myself in a position where I wanted to own Tesla. Unum, which is, again, a life and health insurer, I think we have the same issues that we did when we looked at the other one here. We are seeing some negative earnings growth. Again, when you look at the normal PE, it trades at around 8 times earnings. It's currently trading at 6 times earnings, so it may be worth looking at that price. Vornado Realty Trust, this is a REIT, and it's an office REIT. And office REITs, to me, are really something that I can't wrap my head around. All these people that have left offices, some companies are canceling their headquarters. As you can see, that's shown up in the FFO growth in the last several years. The forecast for FFO growth is negative 4% for the next couple of years. Long term, we're not getting a FFO growth. But I just think this is a pretty cyclical REIT. I wouldn't let the 9.78% yield, really kind of lull me in asleep, because we've had the company been cutting their dividend, pretty dramatically over the last couple of years. So this would be one I'd be very, very careful with. There are a lot of other REITs out there that seem to be a lot more stable. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Once again, I want to repeat, this is a subscriber request video. I've just simply shared with you what I've seen by looking at these companies through the lens of FastGraphs. I hope that made some sense to you. Any of these stocks you want to do your own research and due diligence on. But anyhow, if you enjoyed the video, give me a like, subscribe to the channel, and also, take a look at FastGraphs. You can see what a great tool this is, especially when you look at companies you don't know much about. You can learn so much about a company so quickly by looking at FastGraphs, I think better than any other tool I know of. Thanks for watching. We'll be talking again real soon.